Hi, this is Hetal Sonpal. Welcome to the Leverage EDU University Masterclass on Angel Investment. In this masterclass, what we're going to cover is what's a startup all about, what's the kind of startup ecosystem which exists in India today, what's the various stages which a startup journey involves, what are the various rounds of funding involved in a startup, and more importantly, what does an angel investor look in a startup when he decides to invest, and what kind of parameters which a founder or a startup would need to account for when they interact with an angel investor. Happy listening. Hi, I'm Hetal Sonpal. Let me tell you a bit about myself. An engineer and MBA from a background perspective, I spent more than 20 years in the technology industry. For the last 4 years, I've been working more like a startup evangelist. I coined the term myself because of the fact that what I do as an evangelist for startup is to help startups from a sales, marketing, strategy, and alliances perspective. Why I have got into this role is after having spent a large amount of time with large corporates like Wipro, Microsoft, LinkedIn, and Intel, I felt that I want to give back something to the corporate world. I wanted to give back to the startup ecosystem. I felt that I have accumulated a lot of experience in the India and APJ geography, where my experience could be significantly useful for startups, because startup founders who probably might have about 5 to 7 years experience might not have that amount of experience to be able to work with large corporates from a sales perspective, might not be sure in terms of the kind of resources they need to hire when they want to have a significant amount of growth happening. When the institutional funding happens, investors have different set of expectations. How do you meet those expectations? How do you build alliances with large ecosystem partners so that the alliance partners can also contribute to that growth? So that's been the journey as far as a startup evangelist is concerned, with a portfolio of 20 to 25 odd startups where I've been engaging. It's been interesting, sector agnostic, working across different verticals, whether it's edtech, fintech, B2B, B2C. It has allowed me to work with entrepreneurs in different age group and different business ecosystems. And while I have tried to share my expertise, it's been a phenomenal learning journey for myself as well, where I've been able to understand business models which I would not have had a chance to get familiar with if I had continued working in a large corporate. So that's kind of helped me to differentiate my experience portfolio. While I've done that, I definitely believe in spending a lot of time for myself. I'm an avid runner. I've done 15 plus half marathons and 6 plus full marathons. It was a high point for me last year when I did the half Ironman, and I did a 50K ultra trail run as well. And I want to continue on the fitness journey and make sure that I remain fit and healthy, and be able to contribute more and more to the startup ecosystem. I just love engaging with startups, and I'm always on the lookout for more and more interesting startups with whom I can engage, which I can help and then contribute to the overall economy and the ecosystem by continuing to do more and more good work. Hi, welcome to Leverage EDU University Masterclass. Being the first masterclass, the topic is angel investment, and I'm Hetal Sonpal. I'll guide you through the masterclass. Angel investment is an interesting cast of investment nowadays. And when it comes to investment, the first thing is, what's the investment all about? It's for a startup. Let's start with the definition of startup. A lot of entrepreneurs, when they reach out to me, or a lot of potential investors, they reach out to me, they say, what startup is all about? Startup, if I go by the definition in Wikipedia, means that when a founder or a group of founders start a company and the business is scalable and repeatable in nature, you could call it a startup. So that's where you are. Once you decide that you want to start a startup, it becomes important to understand what is the ecosystem which you are operating in. So let me share a bit about the startup ecosystem in India and how it has grown over a period of time. If I look at the time period, I think in the last 10, 12 years is where the real intense startup ecosystem has evolved significantly. I would not discount the fact that a company like Naukri.com has been around for more than 2 decades, and InfoEdge, which is the founding company for Naukri.com, has really set a very high standard as far as startups in India is concerned. But if you look at the activity in early 2000, if I track back on the potential job opportunities for graduates and postgraduates in India, bulk of the dependency was on large industry houses, which is the Tatas and the Reliance and the Birlas, or it was the large IT companies, the Infosys and the Wipros and the TCS of the world, where the bulk of employment was being generated. And what happened in 2008 was significant. With the global financial meltdown and the recession which followed after that, there was a significantly higher dependency among the graduates and postgraduates to find potential employment here in India rather than going abroad, which meant that they had to look for more and more companies or potential employers with whom they can work. Now everyone can't find a job, and I think that is where people were driven towards entrepreneurship by force rather than choice, and it was a pretty nice choice they made. I think subsequent to that, the government also realized the fact that they need to create a more cohesive and more supportive ecosystem for new companies to be established. A lot of funds were deployed. More than 10,000 crores were sanctioned by government towards startup. The NASSCOM 10K initiative was another significant initiative where there were a lot of positivity and a lot of rules and regulations were simplified for startups to evolve. Other avenues like giving support for tax holiday for profits from startups for more than 3 years. There were some other regulations like this which enabled a startup to be facilitated or brought up very fast. There was a lot talk about red tapeism which used to exist in India long back. A lot of those regulations still do exist. It's still not a dream run for a founder to establish a startup, but things are a lot more easier now than what they were earlier. When you look at startup, there are three significant phases in a startup journey. The early stage, the growth stage, and the advanced stage. I think the early stage is where the initial planning for the startup happens, where you have an idea and a concept and which you want to evolve. The growth stage is where the idea is rolled out and you start acquiring a few customers or acquiring a user base. And late stage or advanced stage is where your business is established and you are probably making enough money that you can put that money back into the business, and you might not necessarily be dependent on external source of funding, which is a pretty good state to be in. But the important element to be realized is there is a step-by-step journey involved as far as startup is concerned. And the first point in the step-by-step journey is the idea. You need to have a very clear idea, which is a business model or a concept on which you want to establish the startup and start a company. While there are a lot of startups which have come up and which have been successful as well, from a copy-paste perspective, where they picked up an idea or a concept or a product or a service which has been successful in some other part of the world, and you decide to roll it out in India and acquire the customers here. That's a very easy thing to do that. But from a uniqueness perspective, you are always better off if you are identifying a business model which is unique. Nobody has done something like this before. So there is a element of differentiation which will help you to stand out, not only when you launch the company, but tomorrow if there are competitors who try and come into your space, you will have a significant edge both from a technology differentiation perspective as well as from a timeline perspective, which will help you to be a lot more successful than any other competitor in that space. The difficult part comes in is not at the idea stage, but it's an execution stage. So that is where planning comes into very important element as well. Planning basically means as to how you're going to execute the plan, how you're going to roll it out, what are the requirements for you to establish the business, whether it is in terms of people, whether it's in terms of technology. You need to find a space which you can rent out and where you're going to run the startup from. What kind of people you're going to hire. Do you have a co-founder? It's very important for you to be able to decide what kind of a co-founder you need. What is your core strength and what is the collaborative or complementary strength which you want from the co-founder. Accordingly, you will look for the right co-founder with the right profile. The other important element which is talked about in the startup journey at the execution and the planning stage is having an MVP. MVP or a minimum value product is where you build a test use case, which could be a pilot or a POC, and then execute that for a limited set of customers or the audience base as the case might be, and try and see whether the visualization which you had for the product or the kind of expectation you had in terms of the response from the customer, whether it is in line with that level of execution or if there is a variance involved. According to that, you will be able to make a judgment whether, when you decide to scale up, whether that product will have the level of acceptability, whether it will be able to grow as much as you expect it to, and accordingly take a decision whether it's worthwhile to continue the business or maybe even need to shut down. The third stage which comes in is, and the most critical stage, is the journey as far as capital or funding is concerned. I would want to elaborate now on the various stages involved in the funding of the startup. The journey for funding for a startup starts with a stage called bootstrap. Bootstrap is the first phase where you have your own personal savings or money which you have set aside for a long period of time, which you feel can be invested in starting a company rather than using it anywhere else. That's the main primary startup capital which you will initiate the company with. The capital which you use in the bootstrap phase should be sufficient enough for you to be able to start the development effort, hire some people if you need to hire from day one, rent a place if you need a proper working place to work out of, and be able to account for the monthly bills as far as any services or any discretionary spend which might be required over and above these asset classes is concerned. You might need to have laptops, you might need to have a good network connectivity. All those things need to be accounted for as far as the startup capital is concerned. From a timeline perspective, you definitely want your own money to last you for about 10 to 12 months, so that gives you sufficient time to be able to roll out the MVP, roll out the product or service, get some customers onboarded, get some revenue on board as well, so that you have a one complete cycle of execution, which will give you a good idea that in the first 10-12 months, if you were able to do X amount of business, if you have additional capital, how long can you sustain that? Whether you can sustain that capital for another 12 to 16 months, that would decide the additional capital which you require. The next stage in funding after bootstrap is called the friends and family round. Obviously, it's named in such a way because you are reaching out to your parents, your immediate family, and your close friends. You're explaining to them that you are taken up a challenging journey of establishing a startup. You have already spent your hard-earned money and you know for a fact that this business is likely to succeed. And for you to be able to grow that business a bit more and be able to get fund from an institution, you need some more capital to sustain that journey for some period of time. The important element comes in terms of why you're not approaching a bank, which is a very obvious question which some of your friends and family would ask. From a sustainability perspective, from a dependability perspective, since you might not have large assets or investment based on which a bank would give you a loan, that could probably be the reason why the bank would turn down your request even if you request for a loan. That's the reason your dearest close friends and family will not be so stringent in terms of a requirement or getting any high degree of paperwork for them to give you that fund, which can help you to sustain for another 8 to 12 months. That fund becomes an important element where you are able to further go on the monetization journey. You might turn profitable with that money, and which will give you a lot more confidence when you approach any third-party investors for the next round of funding. The next round of funding is what this masterclass is all about, the angel round. The angel round is where a set of investors, which are termed as angel investors, are willing to take a bit of higher element of risk in terms of investing in your business, which might be just a shade before you getting to talk to an institution like a VC fund, VC firm for a larger amount of money for the next round of funding. Angel investors typically will be a bunch of investors because they would not invest a large amount of money by themselves. That's why you would need to work and pool money from a lot of small angel investors, small money from a lot of angel investors, which can help you to furnish that round. An interesting element here is that there are a lot of investment entities like Mumbai Angels or Indian Angel Network who have bunched, who have created this organization where a lot of angel investors become members with Mumbai Angels or with Indian Angel Network, and they help you to streamline the process. So they help you as a founder of the startup to streamline the whole process of collecting money for the angel round, where they will do the due diligence, they will do the initial vetting of the startup, and then allow the founder to present to a bunch of angel investors at one shot, so that the investors as a group can decide whether that's a company which is worth investing in. And from a collective or a crowdfunding perspective, this becomes a very streamlined process to be able to get multiple angel investors at the same time. Once you have gone through the angel round and you've been able to successfully execute the business and take it to the next level, that is where things get serious, where you are confident that you can actually approach a proper institution like a venture capitalist fund, which will be willing to consider investment in your company. The reason it becomes serious is because the quantum of due diligence which needs to be done by the venture capital firm would be significantly higher. They would probably deploy a third party to do the tech due diligence, or they might do it themselves. They might request you to sign up with an audit firm which will audit your financial records and check all your financial database and make sure that everything has been accounted for correctly. This is where the journey as far as the institutional funding comes in, which starts with a Series A and can go on to Series B, C, D, and subsequently. This is where you probably have to get onto a serious journey, and that kind of summarizes as far as the entire funding journey for a startup is concerned. Investments in any class has an involvement of risk. It is a risk in a particular investment category which will decide how lucrative or how tough it can become. Startup investment or angel investment is no different. When it comes to startups, the founders need to account for the fact that once they've started the company, they need to account for multiple factors which could actually create problems, derail the business, or lead to a shutdown. The starting point is, especially for a tech-based startup, is to make sure that your technology has the superiority and it retains the superiority for a longer period of time, not only at the start of the business. Which means if you have filed an IP or a patent, if you have filed a patent for the IP, you need to make sure that your IP or your patent remains relevant. You retain the edge, which was the basis on which you started the company. And for that, you need to account for the potential competitors in the global ecosystem, not only in the local ecosystem, and ensure that you retain the edge over a potential competitor from a technology standpoint perspective. The second factor, which might not be completely in your control, but something which you need to account for, is the state of the economy. Today, we live in a very dynamic world where things keep changing on a regular basis. Something which might be very correct today might be completely illegal tomorrow. Something where you had taken a regulation for granted might be changed after a few months after the incorporation of the company. You will need to account for the fact that in case such changes happen in the economy, from a regulatory standpoint, from a government standpoint, what will you do in order to account for that change becomes very important. Not that you can be a fortune teller and be able to predict those changes, but you can indicate what are the steps you would take as an organization, as a founder, to be able to account for such changes. The important element when it comes to investors' viewpoint of a startup is a term called ROI, or return on investment. All the angel investors obviously are smart at finance and numbers, and they would probably want to account for what is the return on the investment which they are making into this startup. While there might be pretty unreasonable expectations from various investors, a typical ROI, a typical annual IRR of 20 to 30% is fairly reasonable to expect from an asset class like a startup investment. Of course, you as a founder would not be too much worried about the actual percentage of returns, but to make sure that you remain profitable or you have a clear path towards profitability is the number one goal. Second is, from a valuation perspective, things get tricky because the parameters under which various investors evaluate or value a company can actually be different even after the investor has invested in the company. And they might be looking at different parameters of growth to be able to judge whether you're doing well, whether you are successful or not. So there are certain parameters which you need to keep in mind in terms of your monthly burn, in terms of your monthly expense which you're spending towards running the business, and what are the investments you're making towards growth. Both of these need to be clearly accounted for at all points of time to make sure that you are remaining at a decent point as far as an ROI is concerned. The other factor which you need to consider is competition. While you might have started the business and there might not have been any other player who would be providing that product or service, let's be fair and honest about the fact that the world is not sleeping. There are potential startup founders who are as aggressive, as young, as dynamic, and as experienced as you, who might be thinking of the same solution while you might not have realized it. And when they launch it in the market, you need to be ready for the fact that the same customer ecosystem which you are targeting might be targeted by your competition, which means that there is a chance that the customer might decide to use the competitor's product or service if he or she finds it better than yours. You need to account for that potential possibility, and accordingly try and expand yourself into the target market, reach out into new markets, build more products and services, come up with associated products and services which you could provide to the same customer, which can help you to stay from a differentiation perspective, stay over an edge or have an edge over the competition at all points of time. The other important factor which comes in when you are going for multiple rounds of investment, whether you're going from a seed round to an angel round to a Series A, B, or C, there is a dilution of your stake, the founder's stake, which happens at every stage. And the percentage of stake which you dilute is important. You don't want to dilute the company so much that by the time you are looking towards a potential acquisition by a large company, or you're looking at an IPO, you're left with a very small stake of ownership, which might mean that you might actually get very small returns from your own investment in the company, which might not make it as wow as an ending as you would want it to be. So you need to account for that element as well. I think every business has variances which come in from different perspective. The variance which comes from people is the most important one to be accounted for. When you conceptualize the company, you said you're going to start a business, you're going to build a product, you're going to hire people to help you to either build the product or to sell the product. In these cases, when you're looking for people to join the company, the skill levels of the people can actually determine whether your hiring is successful or not, whether your company is able to achieve the plan or not. And people variance, retaining people, finding the people with right skill is a tact, and it's something which is not easy for every founder to be able to do it himself or herself. In that case, you would probably be hiring someone from the HR fraternity who is not only going to look at how to get people on board, the recruitment angle, but how to retain those people, how to provide them the right remuneration and the right working environment, which they would find it challenging and interesting for them to not only join your company, but to be with your company for a significantly longer period of time. Further up, I think the demands of the investor are also oriented towards not the performance now, but how are you going to sustain this performance over a period of time, month after month, quarter after quarter, year after year. A sustained growth is what everyone expects, and a sustained growth is what you should be aspiring for. Yes, there would be potential problems which might make you dip your performance, or your performance might dip for a month, for a quarter, or for the whole year. But you should have the necessary resilience to jump back. You should be able to bring your business back after a challenging environment or a challenging business condition, which prevents you from being able to sustain that growth, which might even lead to your growth going down. That means there might be a decline in the business. But as long as you have a plan in place to be able to address such scenarios, the investors are understanding. They understand that these scenarios or these problems can come up. How you recover from them will probably decide the amount of faith which they will have in you, even after you have recovered from that challenge or problem. The other element which you need to account for is the legal and regulatory framework, right? In more stable economies, the legal and regulatory framework remains the same, but in a developing economy, especially the one like India, there are always changes which are being incorporated by the government, which might be good for the government and the industry and the country, but may not be perfectly suitable or amenable for your own business plans. Something which you might have taken as a given might change tomorrow. Some regulations or some rules which you had assumed as going to remain forever might not be the case maybe a month from now, or a quarter from now, or a year from now. The important element which you need to account for is, number one, is to be aware of what are the changes happening. Number two, what impact it creates on your business model. And number three, what is the changes which you will need to incorporate in the business to be able to sustain your business despite the changed regulatory environment conditions. The other important element which comes in, a few years back, India has gone through two large changes from a finance perspective, which is the demonetization and the introduction of GST. These are changes which can change the complete dynamics of the organization. There are startups which had to completely fold over because of their large dependence on cash, which kind of made it big challenge for them to survive in the post demonetization environment. Yes, you would not anticipate a demonetization to be happening every few years, but you need to be aware of the fact that if there is a significant dependence on cash and an activity like demonetization is initiated by the government, what would you do? So you need to have kind of a plan B in place. GST is also another interesting element from a tax regulatory standpoint perspective. You want to make sure that you retain a certain level of ethics and integrity in the business, where you are ensuring that there is no unethical practices which are getting ingrained into the system, either by you or by your colleagues or by your partners. These are practices which are ingrained into large organization right from day one. You might not have accounted for them when you incorporated the company and when you were in the early stage, but when you get into the growth stage, when you have institutional funding becoming an important element, you need to make sure that all your books are in place, all your checks and balances are in place, so that there is no challenge of a regulatory framework or a tax liability which can derail your growth or maybe even make you to shut down at any point of time. Another element to be looked at from a technology standpoint is patents, right? If you have built a proprietary technology, you want to make sure that you have filed for the patent, because investors are going to ask you that question every now and then, to make sure that you are ensuring that you retain the edge in terms of the technology might of the product, so that the competition does not have that chance to be able to grab the customer base which you have worked so hard to get to. Finally, startups are something which is a very active and very wow ecosystem, which a lot of people want to enter every now and then, which means that every founder or every startup might not be as promising as you may be, which means that because of the overall perception of the startup ecosystem in the market, your impression can actually change. What I'm trying to say is that if you're a fintech startup, and if there are a couple of large fintech startups which suddenly are not doing well, which fold over or which shut down, that can have an impact on the impression which your investors have on your startup. Not that you might have anything to associated with that particular failed startup, but just because you're in the same ecosystem, you might also be looked at with element of doubt, and you need to be ready with the perception change which this might bring about as far as the investor is concerned. Having looked at the overall startup ecosystem, having understood what are the challenges which typically are entailed by a startup founder, now it's very important to understand the DNA of the angel investor. Who is this guy? Who is this character? What does he think? What does he want? What are his expectations from a startup? So there are various parameters which need to be accounted for when you look at this person called angel investor. There's one sitting right in front of you as well. So it's very easy for me to talk about this topic because it's coming from within. It's coming from my own origination of angel investment, how I started doing angel investment 4 years back, what brought me to this, and that's what I'm trying to cover in my talk on angel investment itself. The first thing you think about angel investment is, where did this term come from, right? Who decided to call us an angel, right? If you trace back the history, I think the origination of this word happened in Broadway. Yes, when people were evaluating source of funding for theater performances at Broadway, a gentleman by the name of William Wetzel, who was part of the University of New Hampshire and who also founded the Center for Venture Research, he was the one who's been credited to have come up with the term angel. Now that we know that the term is angel, obviously you expect the person to be good. You expect the person to be able to help out the startup from a need from fund perspective. And that's what angels are there for. Sweetly positioned between the friends and family round and the first venture capital round, the angel investors come in when the quantum of risk involved in investment in the business is still significantly high, which would mean that a venture capitalist would not come in. And the friends and family round has been exhausted, which means that the founder cannot approach his near and dear ones for more funds. That's when the angels come in. Now, angels come in, and angel is a plural here, which means that you would probably be looking at multiple angel investors to contribute to the whole round. The reason being that the quantum of money which typically the angel investors put in may not be sufficient enough for just one angel investor to come in. I'm not saying it's impossible, but it's unlikely. And that's going by the historical track record or a performance perspective. If you personally ask me what I look at from a angel investment perspective, what are the parameters? I have 4 simple parameters based on which I make a judgment whether it's worthwhile to make an investment or not. The first one is profile of the founder. That's something which, yes, the founder cannot do much about, but that becomes important from a decision-making criteria perspective. What has he done before? What he or she has done from a academic perspective, where and what degree has she studied. Second is in terms of where he or she was working before this, what kind of a work experience he or she has in the industry. I'm not a big fan of the IIT IIM brigade, which says that unless you're not from a top-notch university, you cannot succeed. But yes, I would definitely give some extra brownie points if you are from an IIT IIM. However, if you're not from an IIT IIM, that's not a negative factor for me. I would still look at what you have done in the past, what is the qualification you have, which can still be an important factor from a judgment perspective. The second important factor is the uniqueness of the business model. Now, as I mentioned in the previous section, it's very easy for you to identify a successful business model or a use case which has been executed in some other part of the world and might have led to a significantly large startup. It might even be a unicorn. And you might say, hey, this product or service has great potential for executing here in India, and I can go and roll it out. Very much possible. But you need to be aware of the fact that if your business model is not unique, if you're copying someone else's idea, then someone else can copy that as well. So given a choice, I would probably give a preference more to a unique business model than to someone who's going to make a beautiful copy of an already successful business model and just roll it out. The third important element which I consider from a personal criteria perspective is scope for monetization. Now, scope for monetization seems pretty obvious, isn't it? But there have been many instances of a B2C startup where the founder is more keen on getting X number of downloads or getting Y number of users and an MAU or a monthly active user as an important parameter of success. While there might be still some businesses where an MAU, especially a content-driven business where you have a great content platform and you want to get more and more users to come and view your content, and you are contented with the content which you built, pun intended, that might be good from a initial stage perspective. But at a later stage, once you have grown the business to a certain extent where you have significant number of users, how you're going to monetize the platform, where is the revenue going to come from, becomes important. Because many of these businesses which I've just cited, which are content business, are primarily dependent on every subsequent round of funding bringing in more funds, which will allow for you to sustain the business. But honestly, it's not a sustainable business as far as my parameters is concerned. I would definitely want the entrepreneur and the startup to become self-sufficient at some point of time, for which it is important to have a clear monetization journey. So you need to have accounted for the fact that the monetization journey or the path to profitability is very clear, and you would know when the business will start making enough money so that you can put that money back into the business rather than continuing to look for an external source of funding. The last and the most important parameter is scope for exit. Scope for exit sounds very obvious, isn't it? But many times the business has not identified a clear scope for an exit for the angel investor. Now, the way the investment journey works for an angel investor is that he would be looking for an exit in the subsequent rounds, which would typically be a Series A or a Series B. It's more likely to happen in a Series B than a Series A, because when a venture capitalist or institutional funding happens in Series A, the initial investor is more keen on putting the money into the business rather than paying for the existing investors, which is the angel investors, to get an exit. So it's more likely to happen in a Series B. And if in a Series B you are not fortunate to get an exit, you might have to hold on to your shares till the company goes for an IPO or there is an eventual acquisition of the company. But whatever it is important for the founder to have clearly outlined from an acquisition perspective which are the potential companies which might want to acquire the startup. Or if you want to go for an IPO, which is the ultimate exit, then you know that in how much time, which is number of years, you are likely to go for a IPO kind of a scenario. That kind of gives the assurance to the angel investor what is the rough quantum of time for which the investment is being put into. And obviously that will decide the quality of the returns. You might be able to give a 5x or a 10x return. But if it takes 10 years or 15 years for a 10x return, it's not going to be as sweet as it would be 10x return in, let's say, 3 years or 4 years. So I think that's another important criteria to be considered. So if I look at these 4 important criteria, I think they kind of ensure all the variances which can possibly come in from an angel investment perspective. Now, if you broadly look at the angel investors, there are different people who become angel investors. Because of the recent slowdown in the real estate market, and recent is almost for the last 5 to 10 years, there's been a huge shift. People who had actually thought of real estate as an investment class decided to look at alternative investment class. And the fact that the returns from the asset class of gold has also not been so lucrative. The stock markets or the equity has only recently started showing some relatively positive signs for growth. A lot of people got interested in angel investment as an interesting asset class. This included not only traditional real estate investment houses, but even film stars and industrialists have started looking at angel investment as an interesting option to turn to, which basically means the nature of expectations or the nature of details which an angel investor might be expecting from a startup founder can also vary based on the background of the individual. And I think that's something which the founder has to be prepared for. So typically, once the investment has been done, there might be a quarterly forecast or a quarterly analysis report which the founder has to share with the angel investor, and there might be a face-to-face or there might be a call where he needs to give a briefing in terms of what's the progress been so far as the business is concerned. And that's where the typical questions from different angel investors can vary, and the founder needs to be prepared for all those questions, which on paper will be more oriented towards finance and how the business is doing. But there can be some interesting questions if an interesting competitor has popped up, and whether the founder is aware of the competition, what he is doing to ensure that that competition doesn't eat into the market share of the founder also becomes important. Sometimes the angel investors are want to be more involved than the other investors. They might want to have more frequent conversation, which might not be enough from a quarterly analysis perspective. He or she might want to meet the founder on a regular basis, which could be once in a month or once in 2 weeks. He might want to meet with the team as well. He might want to proactively help the founder from networking perspective by identifying potential customers and getting those introductions, which is another interesting element where a lot of angel investors can be very helpful or beneficial, because they might be seasoned players in the industry in which the founder has the business, which means that they might be able to get you, the founder, connected to important CXOs in different large enterprises, or might have connects from a potential alliance partner perspective. And that becomes then a significant advantage to the founder, which he might not have accounted for in the initial stages when the investment was being considered. Sustenance of the monetization journey becomes very important, which means that you need to have a sustained growth plan, which will account for the different possibilities as the business grows and as the ecosystem evolves. Net, if you look at the way angel investors are in the market today, they are making a significant contribution to the overall startup ecosystem. They are taking up high-end risk, which many institutional investors still dread to get into. We've recently been hearing about a lot of venture capitalists identifying early stage as a very important element to look into, and they are willing to initiate new funds which are oriented towards the early stage of the company. But that's something which is a process which is few and far in between, and we still feel that the founders or the startups will definitely need to look at a larger and a more involved set of angel investors on a constant basis to be able to support in the initial stages. I hope through this masterclass I've been able to give a good set of information to current and potential founders who will have a clear idea in terms of what angel investment is all about, and when they decide to get for an angel round of funding, they would exactly know what they're up for. Thank you very much.